Cool. So for this meeting, I did have a few topics I wanted to kind of discuss as a group, and then we'll get into our, personal discussion. So I'm sure most of you are following the market and tracking kind of some of the changes that we're seeing. So I want to highlight on, a few of the things I'm seeing and kind of my personal strategy as to what I'm looking to do and how I'm going to navigate here. So I think I mentioned 2 weeks ago, for anyone who was here, there's, I think, a lot of opportunity in the market as it's changing. I think this is probably the best opportunity that most of us who have been investing for the last, if you've been investing since like 2010, which I know most of the investors I network with started after the last crash, this is probably the best opportunity to buy since that time. Obviously, we know the pit of the market in hindsight, back in 2009, 10, 11 was a great time to buy. And since then, exponentially every year, we've had more and more competition, and I jumped in unintentionally as a live-in flip in 2011. So I was fortunate to buy at the really low end of the market. But I wasn't intentionally investing or even following the market until like 2015. So all I've seen the last 7 years has been increase in values, increase in rents, and increase in competition. And I like to look at it as, you probably heard a lot of different investors talk about things like this, but it's like when a market cycle has momentum like that, like we've seen the last 12 years, especially the last 3 years, let's say, I think a lot of asset types become very much like a fad, so if you followed crypto or stocks or any of the stuff that happened on, no problem, Liam, thanks for jumping in. If you follow on any of the other types of investments out there, you've probably seen it's been a lot of activity from people who probably aren't traditionally investors. And I think real estate was no different. I think real estate has had a lot of people come and go, that it's more of a fad. And I don't want to necessarily say it's a fad for them. That's not the way they look at it, but they're getting into it strictly because they see everyone else getting into it and they have a fear of missing out. And while I'm not necessarily saying it's a negative thing or a reason, or if you feel like maybe you're one of those people or know somebody like that, it's not, I'm not trying to talk down to them or say it's a negative thing. But what I am saying is that if your mindset is getting into real estate for maybe the wrong reasons, then this changing market could become extremely risky and challenging for people with that mindset. So that's why I want to point it out. It's just something I've noticed and thought about, and it's some of the things I'm going to talk about tonight are kind of based around that philosophy. But if you guys are seeing that, like, I'd love for you to jump in. Anyone, I don't know if you know somebody, if maybe that's what drew you to real estate in the first place, and now you are actually learning some of the fundamentals of it. But I'd like to hear your guys' thoughts on that if you're seeing what I've seen.
I see a lot of people, at least from the meetups I go to, see this new shiny STR thing. Like that's like the new kid on the block, and people cannot stop talking about it. And it's clear like a lot of them haven't really done their research, because when I did my research on it, no offense to anybody who's in that space, but it just seemed like it's just another job. Like it's not really like an investment. It's so much work, and I don't think people quite fully appreciate as much work as it takes. So that's one of the blaring things that stuck out to me when you mentioned that.
Yeah, no, and so specifically short-term rentals, that's a great point. And yeah, I think that's definitely like the fad of real estate right now. I mean, the last couple of years, especially since COVID started, I've had so many people that I've talked to that are trying to get into real estate because they want to go into short-term rentals. And like you said, there's nothing against that asset type. I'm interested in it as well. If the right opportunity came along, I would probably dive into it as myself. So I'm not saying there's anything wrong with that, but to your point, to me, short-term rentals are like, you are building a business. Like now, not that all long-term buy and hold real estate isn't a business, it is, but you are buying a business that if you do not have system or people in place, you're buying a job, you know, to
Mhm.
your point, Liam. And to me, I think that differentiates it a little bit from long-term buy and hold rentals, because long-term buy and hold, you're going to have a lot more passive ability, and it's scalable passively. So yeah, I think it differs with the short-term rentals. And I think it's extremely risky with the short-term rental market going into the next like 6 to 24 months. That's one of the things I was going to bring up, some of the risk I see in the changing market. But I think short-term rentals are one of those things that could be really risky going forward.
Mhm.
Anybody else have anything they want to add on that?
Joe, I was just gonna say I agree 100%. And my perspective is more with stock investing, which I've been doing since 2014. But I've seen that same sentiment past couple of years. And I mean, right now we're going through a pretty painful period, right? But again, you know, the fundamentals of investing, in my opinion, are the same. So market sentiment, it's pretty powerful. It's a pretty powerful thing. And the same thing with FOMO, right? Fear of missing out.
Does anyone in this group have short-term rentals at all? All right, Jake, you got anything to add on that?
So there are family rentals that we just put up, and I will say I've been drinking from the fire hose on that. But we know people that have them. It is definitely the new fad. You've got to definitely take it as, if your area is going to come down, that isn't reliant on tourism, just as kind of a nice place to get away from, and there's not hotels around, you need to understand that you need to have other exit strategies. Luckily for my family, it's our vacation area,
Okay.
and we can pay it off no matter what.
Okay.
So that's the good portion, but not everybody has that capability, and not everybody did it that way. Some people bought it just because that, and then just because it's a good place and they know it's going to bring them value. But that county, that town, or whatever can crack down on short-term rentals. As you know, there's been many markets that have done that, and you're cut. So, and then you got to find another out in order to fill in, or you sell the property, or whatever you can do.
No, that's a great point. And I live in Milford, and the city of Milford just passed a resolution recently basically outlawing short-term rentals. So you have to be zoned in a commercial area, basically excluding all residential neighborhoods that are zoned for residential. And I don't remember the days, but I think it's you can't have a tenant less than 30 days or something like that. And I'm going to try to look it up. But yeah, it was a huge hot button issue in the local city of Milford government, small town here in Cincinnati, for anyone watching across the country. But there was a lot of people who own short-term rentals, and they tried to fight it, but the city ultimately passed it. And because there's so much demand for housing here for regular residences, and it's so difficult to find a house, I think there's a lot of external pressure to outlaw short-term rentals. And they were building a couple new hotels by the highway. If I had to guess, I would assume some of those hotels, put some money behind the politicians to probably outlaw those Airbnbs as well. Anybody got anything else to add on short terms? Go ahead.
I was just curious with the short-term thing. It seems like a lot of the sentiment I'm seeing is, unless you have a property that's bigger for like a family get-together type situation or something kind of special, it seems like it's kind of moving away from when Airbnb first started taking off, couples and single people were kind of saying, hey, this is like a cheap hotel. I can stay somewhere kind of nice for a couple days. But now it seems like the costs are comparable to hotels. And it seems like people are kind of swinging back to saying, hey, I'll just stay in the home 2 suites or something for $100 a night, rather than dealing with all of that, unless it's a big family get together. Is that what y'all are seeing as far as actually owning them, that you need a bigger place or something kind of special, like you're right on the lake or something similar to that?
So in my opinion, if I were to go to a hotel or pay an extra $50 a night and have a whole place to myself where I'm not going to have to deal with people, deal with worrying about, who's going to come in my room, who's going to do that stuff. I think that's where it's at right now. Not a matter of, oh, it's $50 less. If I have the extra $50, I'm definitely going to be like, I know this is my place, and anybody that comes into there is not supposed to be there. It's more of I can do what I want here versus I have to go through a hotel lobby. I have to go through a key door. I have to go do this. And it's just this generic, every hotel is roughly the same, right? So you get a personal experience when you go to an Airbnb. It's a home. It's a place that you can sit down and watch TV in a 65-inch TV versus a 32-inch TV that is facing two beds, right? So that's where it comes to me. If I go to some place and there's an Airbnb roughly the same price or slightly more, I'm going to take the Airbnb or Verbo or whatever it may be, because it's nicer. It's more of an experience. There's more rooms, that whole aspect of it. It's not just I'm going to take the hotel because it's slightly cheaper.
Yeah, no, and I think it's very destination dependent. The one thing that concerned me as I've looked at a couple of my properties for potential Airbnbs is that if you don't have a draw, like a local community draw or a destination or tourist attraction of some sort, to me, it's very difficult to rely on consistent demand. So that was my concern, and why ultimately I opted on a couple of my recent properties for corporate leases. And I can talk more about that if you guys are interested. But basically, to me, it's kind of a middle ground. It's like I'm not having to do the turnover of Airbnb, but I'm getting higher than market rents, and I'm dealing with somebody who's going to guarantee to pay. But I have basically potentially transient tenants because a company is placing people there, and they may be there for 6 months, they may be there for a year, but I actually have no control over who's in the building, other than, there's some rules around who they can place. But again, I can talk more about that. But I personally opted not to go the Airbnb route on a couple of the properties because I did not see enough local draw. And when I did my due diligence, with the things available, and admittedly, I'm not an expert on Airbnb, so this is limited experience, but I looked at the local Airbnbs, the rates they were commanding. I looked at the data around some of the algorithms out there that can give you, I don't remember, it's AirDNA, and I think there's another one. They give you estimated fees that they'll be able to bring in. And to me, it wasn't worth the turnover, hassle, the cost, and the risk of vacancy without that external draw that I was talking about. Real quick, so the Milford rules, I was able to find it. So, and this is something that I think we're going to see a lot more of around the country. So I think it's kind of cool that, well, not cool for people with Airbnbs, but something that, is literally happening right now. They're passing this law, and it says any property that is going to have tenants for less than 90 consecutive days, that qualifies as a short-term rental. And so in the city of Milford, which is probably 3 square miles and maybe, 7,500 residents, so not a very big town, they're only allowing 30 licensed short-term rentals. So that's a very small percentage of inventory. If I had to guess, I'd say there's probably a few thousand houses. So you're talking about like less than 1% can be qualified as a licensed short-term rental. It cannot be within 300 feet of another short-term rental. And they will not issue more than 30 active licenses in any given year. And you have to get approved per dwelling unit on each license, meaning if you have a 4-family, then you would need 4 separate licenses to rent all 4 units short-term. And they must be renewed every year on January 15th. That's when they award these licenses, and it expires every year. And you have to pay $500 if they approve you as a licensure. You have to pay $500 fee. So as you can see, they're doing basically everything in their power to pretty much extinguish the short-term rental market. And I can say from my own experience, having clients who came to town here that I've met with, a lot of them, were kind of on the east side where I'm based, and a lot of them picked Airbnbs, in and around Milford, and there was a lot more than 30, for sure prior to this law. So I don't
Are
know if
they
you
just
guys
gonna
saw-
have like a lottery draw to see who gets it each
Yeah,
year?
I don't know. It doesn't have anything on here on how they're selecting criteria. I would assume it's probably at random, because that would be the only fair way to do it. But and I would, what'd you say?
Did they grandfather anybody in?
No, I no, and I remember the I'm in like all the like local Facebook groups. I mean, there was a lot of uproar. So I think they were flat out outlawing them, like, and then starting that license process this year. So I think the first issuances are going to be this January 15th. They may let them operate till the end of the year. That I don't know.
Those politicians just want to line their pockets a little bit.
Yeah, it's probably, if I had to guess, but especially because it all happened coinciding with the new hotel development. My
Yeah.
guess is there was a lot of pressure from some of those hotels. But anyway, that's interesting to see if that's going to happen more and more across the country. So all of that's back to the main point, right? So we're in a market change. There's a lot of these fad types of real estate and types of investors that I think are going to be the most at risk. Obviously rates, I'm sure if you guys are paying attention to rates right now, you're looking at 7+%, even on a personal residence, probably more for investment property. I've seen conventional loans quoted as high as 8% for investment property in the past week since the CPI came out. For anyone not familiar with that, every month the Bureau of Labor Statistics puts out a consumer performance index where they are taking a conglomerate of the data and giving us an estimated inflation rate. And I think it was 8.1% for September. So the October data was basically the September numbers, the one they just released. So something like that. If I'm wrong, feel free to correct me. It's been a couple of weeks since I read up on it, but anyway, it projected or came in higher than projected again. So every month for the last 4 months since they started really raising rates, they've hoped that month over month the CPI would drop, and it has not. Therefore, the Fed is in all likelihood going to raise rates, and I think their next Fed meeting's in like the first or second week of November, and right now the estimation is 75 basis points. So right now the loans, if you go and get a loan today, the conventional loan, they're building in 75 basis points based on their assumptions of where rates are going to close next month. So with that in mind, obviously we're seeing more days on market. We're seeing less buyer demand. We're seeing less competition for investors. We're seeing a lot more like my last couple of listings I've sold, sellers are having to be way more flexible on occupancy terms, closings, like timing. And they're having to give concessions. A lot of people are asking for money for rate buy downs, very common thing that buyers are getting right now. So all of this is to say that, the balance of scales with buyer and seller demand is definitely shifting back towards the buyer's favor. Because we have such low inventory still here locally in Cincinnati, and everyone I talk to across the country is seeing the same pretty similar patterns. Because we have such low demand, it's not, I wouldn't call it a buyer's market, but it's definitely slowly tipping the scales back to an even market. Any questions, anything anyone wants to add on that specific piece? Anybody seeing anything differently than
Joe, is that
Yeah.
is that the number one thing you're seeing is buyers asking for that money for the rent or for the rate buy down?
Not necessarily. I think buyers are, so, I mean, obviously the retail market and the investor market are totally different. Obviously, I work in both, but I predominantly work in the investor market. But I think the retail market's getting hit harder. And the reason why is because most of the people who have to sell right now, and I can say this strictly from my own personal experience because I'm buying a new personal residence right now. Almost everybody I've talked to, whether it's listed or an off market, we did a lot of off market, outreach trying to find a house, has very similar stories. And this is who it is. Divorced, that's very common. I mean, I would say half the people I've talked to selling right now are getting divorced. And so, there's like 1,000 active listings on the Cincinnati MLS. Like I would say a large percentage of the retail houses on that MLS are divorced people because they have to sell. Elderly people who are downsizing and trying to get, less square footage Probably another quarter of the people I've talked to selling right now are older and trying to downsize, or people with no mortgage. That's like the other 25%. So obviously I'm, these are generalities. I'm sure there's other people in that mix, but I would, based on my personal experience, 20 or 50% divorce, 25% elderly, 25% no mortgage. And a lot of the people with no mortgage are elderly also, because usually they've lived in their house a long time, right? Very few people in their 20s or 30s have a paid off house, statistically speaking. But those people have no benefit of holding on to their house, right? Because they're personally motivated to sell. Now on the investor side, obviously that's a lot wider, gamut of reasons why people are selling. And I think a lot of people on the investor side who are selling right now are the people who have been selling really for the same reasons as the last 3 years. They're rolling it into a bigger deal, right? A lot of people are 1031ing into bigger stuff if they're selling smaller deals. They're just in over their head and they can't handle it, or they don't have a good manager, or they can't self-manage, or whatever. They're trying to get out of the landlord business. You have your elderly landlords who are just retiring. Like a couple of my off-market deals I bought in the last couple of years, same thing. You have people who are just trying to get out of the game. They're in their 70s, 80s. But those people are less motivated because a lot of them, at least at this point in the market, are not desperate, right? Retail buyers in most cases are desperate. They have to sell because very few people are looking at the market right now saying, oh, now's a great time to sell my house. If they were doing it because they thought it was a great time to sell their house, they would have probably done it 6 months or a year ago when, they were getting 20, 30 offers on, relatively unappealing houses. So that's what I'm seeing. I'm sure it obviously varies market by market, especially when you get hyper local. But I think that's a pretty common theme throughout the country, is still low in inventory, but motivated sellers, desperate sellers, especially on the retail side.
Joe, well, I guess retail and investor side, but have you seen more of an appetite for seller financing or creative financing sub two? Because at least from what I've seen, I want to go bigger than kind of 300, like the triplex I got, and it from what I've heard, lenders and banks are really tightening up, giving lower LTVs, and banking is getting harder. So, I've definitely started to pursue research on the seller financing thing. Is that something you're seeing? Has a little bit more activity?
Well, it depends on why the seller wants to sell. So generally speaking, it's very unlikely because there's usually only very specific types of criteria as to why a seller would want to do that. I've bought and sold on seller financing, so I'm familiar with it. But I would say in the last 7 years, I've been in real estate, less than 1% of sellers are interested in it. Now it may start to make more sense as, let's say a year from now, rates are 13%, which I don't think is impossible to happen. I think you're going to see a lot more sellers who are like, hey, I'll give you an 8% rate. If they got a paid off property and they're low risk, do I see that 1%, moving up? Yes. Is it enough to really change the supply dynamic? Probably not. You know what I mean? And it's extremely competitive, right? Because the same people who want seller financing, obviously with the right terms, all of us want seller financing, right? So you have to find somebody that makes sense for it. And the people it makes sense for are people who have a paid off property. Those elderly landlords we were just talking about, if they have a paid off property and they still like that monthly check, and they don't want to pay capital gains tax, like they're not 1031 into something else. You kind of need all three of those things where they still want, residual income. They have a paid off property, so it's low risk to seller finance land contract. And they are also, in a position where they want to get a return on that equity without needing a lump sum, meaning that, they don't need to 1031 it into another property. So you kind of have to have all of those in a row. And it's just rare, right? You can kind of look at that dynamic. It's hard to find. And also, I've seen sellers who were perfect candidates for seller financing when I was doing a lot of direct mail and off market stuff. It's like, they can't wrap their head around it. I feel like I'm I feel like I can't talk tonight, but generally I'm pretty well spoken and I can usually articulate things in a way people can understand them. Like I've had so many conversations with direct to seller where they're like, yeah, dude, I have no idea what you're talking about. Like, you know, and I'm like breaking it down like, you know, like a 5-year-old. And it's like, yeah, like I don't understand that. You know, so it's like people aren't,
Yeah.
they can't make a confident decision if they are confused. So that's
It's
another
like they need to
skill.
know, they already
Exactly.
kind of need to know about it and be primed for it.
Yeah.
Because if
Yeah.
you're trying to bring it to them for the first time, unless they're very open-ended, they've already thought in their mind, I'm getting the check
Yeah.
and
Yep.
this sounds shady.
Yeah. And
Yeah.
they're
They
counting, they're
don't look
counting
at it as,
dollars.
they don't look at it as, hey, I can make the interest instead of the bank. I can do these tax things. The people who are educated enough to do that already know about it. So yeah, it's kind
Yeah.
of a tricky dynamic.
Yeah, and like I give you one example. I had a really good candidate for seller financing. This is maybe a year and a half ago. Off market deal, great deal. I was happy to give the guy what he wanted for the property. And like we had all verbally agreed to everything. I explained the whole thing, everything about land contracts, how they work, all the upside for him. And he literally calls his financial advisor, right? Like a stockbroker or whatever. And he calls me back a couple of days later and he's like, yeah, my stockbroker said that it's not a good idea to do that. And I'm like, why? And he's like, well, he didn't really say why, but you know, and I said, well, what were you going to do with the money when I bought it before? Oh, I was going to give it to my stockbroker. So it's like, well, you know, this guy just lost, you know, probably a $200,000 commit, you know, whatever he would have made off a $200,000 investment with his stocks. So it's like, yeah, of course the guy's telling you to take the money and run instead of, you know, making whatever 7 or 8% interest for the next however many years, you know. So again, like Josh said, you not only do they have to understand it, but you know, they have to trust you and it has to just fit their situation. So
Mhm.
I think it is definitely something to look for, but just honestly, in my experience, it's very difficult to find.
Yep.
All right. So another thing I want to mention was like, so kind of what I'm projecting, and obviously, you know, none of us have a crystal ball, but people ask me all the time. So I figured I would at least run through a few of my thoughts that I where I see things going. So with the Fed, I think being the biggest lever in the changing market here. Normally, I would not really trust anything they say because in the last 7 years, a lot of what they say has just kind of been posturing. And, you know, especially under the last administration, they would come out and say this, this, and this, and then never do any of it. One thing I'll give the current administration for and their Fed chair is like every single thing he said has happened, like to a T. So they have not been, you know, they've been very transparent with what they're planning to do. And he has said for the last 3 or 4 Fed chair meetings where he's like, until inflation's back to 2 to 3%, which is what we want nationally, we are raising interest rates. And as we all saw a couple weeks ago, the CPI is 8.1%. So we have a long way to go. Another thing is energy prices are back on the rise again. If anybody's paying attention to that, I'm sure, you know, if you're getting gas and paying your energy bill, you're seeing that. So the problem is when energy prices go up, that affects the CPI in a big way. That's actually like half. Energy costs are like half of the total CPI data. So I don't see anything trending in a good direction as far as rates go. Ultimately, all this comes back to what are we going to be paying for mortgage rates? Again, it's not a direct correlation, but the data we have and the way it's trending tells me that I think rates are going to continue to increase. And I think they're going to increase at a minimum of 75 to 100 basis points per Fed chair meeting, meaning that they're already priced in, like I mentioned in the beginning. So we're already looking at 7+% now. But if we have another bad CPI report in November, then I think by the end of the year, we're looking at 8+% rates or close to that. So let's call it 7.5 to 8.5, somewhere in that range. I think that's very realistic and likely based on what we're seeing. And if you extrapolate that out over the next 6 months, will that continuously happen on pattern? I don't know, but it has the last, 3 or 4 months. And I think most people 6 months ago would have never expected that to happen, not as consistently and as quickly as it has happened. So anyway, all that's to say for the next 6 to 24 months, I think we're going to be in this kind of volatile rate increase to some level, whether that's, you know, a percent a month, whether that's a 1/4% a month on average, I don't know, but I don't think it's coming down anytime soon. And I'm looking at probably at least 24 months until we can expect rates to either level off or hopefully, you know, start trending backwards. That's just what I'm seeing with the data that I'm looking at. Another thing I think obviously we have to account for is with rates increasing, I think not only is price growth going to stall, I think it's likely that we'll see price corrections. And we've already seen that a little bit, like hyper locally, you know, in certain neighborhoods where there's not much, you know, buyer demand for investors or retail. You're already starting to see some of those prices come down, average price of sale. But I think generally across the country, we're going to see a lot more price corrections over the next 6 to 24 months, unless those, you know, rates do come down. And I think the reason it's important for us, and one of the things I want to talk about tonight was with rent growth. You know, I think that I'm guilty of this as well, and that's why I want to talk about it. For the last 7 years, I've always underwritten my rents increasing year over year, always. I've never once had a model on a spreadsheet of a property I was looking to buy where I just stagnated rents or had negative rent growth, right? I mean, you know, if anyone in here has projected rents to go down on a property they're buying, please feel free to speak up because I'd love to hear your thoughts on it. But, you know, personally, I never have. And right now, I think that is, I don't want to say it's likely, but I think it's possible. And I think if you're underwriting new deals and they don't make sense at today's market rents, or like probably, you know, probably what I'm going to do is look at like a 10% rent drop. If my property doesn't at least break even or cash flow a little bit with a 10% rent drop off, then I'm probably not buying it, you know, right now. That's kind of where I'm at with the market. Now, some caveats to that. I think most of the properties, and I'll speak for Cincinnati market, most of the properties that are being sold are under market rents. So I want to make sure that people understand what I'm saying. If you're buying a property that has 500 current rents and the market rents are 900, I'm not saying that they're going to drop 10% from 500, but I am saying they could drop 10% from 900. So if you can buy a property at 500 rents and they make sense at 800, even though we know the market's 900, it still still may be a great deal. So I just want to make sure that, you know, you guys are understanding that nuance, because almost none of the properties I see sold, whether I'm buying it, I'm selling it, my clients are buying it, none of them have market rents, because back to the previous conversation, the people who are selling are, you know, your top 20% of landlords are not selling their properties right now, unless they're rolling into a bigger deal. But the cream of the crop, who keep everything perfect, they have the best tenants and have everything, you know, running like a well-oiled machine. Those are not the people kind of unloading inventory right now. So typically when you're buying a problem that you need to fix that somebody else is trying to get rid of, you know, and I know everybody in this room who's bought property probably bought something that needed to be either renovated, better tenants placed, or some sort of efficiency with that property had to be met, you know, and some of you, I know, you know, from knowing you that was the case. So anyway, that's what I'm seeing. That's what I'm underwriting on my deals. Anything anyone wants to add or jump in on that? And I have one more topic.
I'm curious with your thoughts on rents. I would expect that with rates going up, that the demand for rentals will stay the same or go up, where everybody who was planning on buying a house in the next 2 years are now saying we're going to have to wait for a while. How does that square with, you know, the rental rates itself? Does that help hold it up? Do we think that could even see a rise in rents? I mean, those are kind of competing things that are both true. I don't know if you have any thoughts on that.
Yep. So here's what I'm seeing, and I agree with you completely. And that's why I'm not panicking. You know, I'm not saying the sky is falling. All the deals I bought in the last 2 years, I think are going to hit or exceed my metrics that I underwrote them for. And that was even with built, you know, obviously assuming rent growth, because there is still a ton of rental demand, and there's still a massive housing shortage nationally, but you know, specifically to Cincinnati where we're at, a lot of us are at. So I don't think there's going to be a 20, 30, 40% rent drop like we saw in 08, 09. I don't think we're headed for a cliff like that. But here's what I do think is going to happen. I think a lot of these people who cannot buy houses because now they can't afford it, or they just missed the last 2 years with low rates, or as we all know, there's a shortage of inventory. One of those reasons they can't find a house, that's going to put downward pressure on rentals, which is a good thing for landlords. But I think a lot of people, like we saw in 08, 09, 10, 11, are going to be forced to live with family, are going to be forced to come up with, cohabitation where they're just out of the rental market. And one specific example I can give is that I've leased the same apartment building for one of my clients 3 years in a row. And I can literally go back and look at our inquiry data. Same apartment, nothing was changed. The only difference was we had slight rent growth every year. Okay. So from, let's say, 2020 to 22, nothing changed. The apartment was still in really good shape. They did little touch ups after each tenant. And it was like every summer, right? Up until this, just like a couple months ago. My inquiries with the exact same marketing strategies dropped like 25% every year. And the reason why is because rents were going up. We were pushing out the so your qualified buyer pool or renter pool shrinks, right? And as we head into a recession, and we're already in one, as we continue into a recession, people are going to potentially lose jobs. People could potentially lose wages or have reduced wages because, we know with all this inflation, a lot of companies were giving out big raises, bonuses, all that other stuff on top of the government spending. That propped a lot of people up in their incomes. And I think that's going to continue to compress now. Anyway, all that's back to the point where that demand dropped. And it's not because people don't need houses, because they do. It's because they literally can't afford them. So if you are a good landlord and you underwrite your tenants and are very strict in your renting criteria, like I am, even if you have 100 applicants, you might only have a couple that are qualified, if that makes sense. So it's not necessarily just because there are people who want it, but we don't want to just put people in our properties because they want it. You know what I mean? So there's again, a little bit of fine nuance there to consider. But again, I'm not panicking. I don't think that, we're going to wake up tomorrow and nobody's going to want to rent our properties or anything like that. I'm just saying that there are certain things that I'm following that are concerning, which is why I'm being more conservative with my underwriting than I have been the last, 5-6 years. And so that's the point I'm trying to make. And the last thing, so what I've been doing the last 7 years is BRRRR deals. And I think BRRRRs are actually really risky right now. And so are flips. So I don't know if anyone in this group flips, but flips, I think, are probably the most risky because, as we know, retail market is struggling right now. People are taking big price drops. People are having to give a lot of concessions. So I think that is the most risk. And when you're doing a flip, you are looking at a simple formula that has been around forever, right? You're looking at, what can I buy it for? What do I have to put into it? What's my profit margin? What can I sell it for? Well, the last piece of that is the most important. What can I sell it for? And right now, you could as an agent who sells a lot of houses, you could literally call me and say, hey, Joe, what can I sell this for in 3 months? I have no idea. I have no idea. It could be 10% more than it is today. It could be 30% less than it is today. And there's no agent who can honestly look you in the eye and tell you they know. Because if you would have asked me 3 months ago what something was worth today, I would have been totally wrong. Totally wrong. And if you would ask me 6 months ago, I would have been even more wrong. So the point I'm making is that we need ARVs to have accurate margins on flips, right? And for BRRRRs. And I think both of those right now are trying to hit a moving target, and it's extremely difficult to do. So, if you guys are doing BRRRRs, if you're doing flips, I would be extremely cautious. We already talked a lot about short-term rentals. I think this fall in the same boat because we don't know what rent demand is going to be on the short-term rentals. We don't know what values are going to be on short-term rentals. Those are valued a lot like commercial properties in most areas, where if you're getting loans based on income and you're not able to keep consistent income, that's going to affect the value. So the what I'm doing specifically, the last couple of years I've been a little bit more aggressive trying to find any deal that makes sense anywhere. I'm kind of refining my strategy like right now as we go into the winter, and I'm going to be extremely intentional about what neighborhoods I'm buying in. Like if I don't believe in a neighborhood to have extremely high demand over the next 5, 10, 15 years, then I'm not going to risk it, because we've seen, again, on a general basis, high demand everywhere. Like every neighborhood in Cincinnati, even the really rough neighborhoods historically, have had ridiculous rental demand the last 5 years. So I don't think that's going to be the case. I think tenants who can afford to rent are going to be looking for the best products in the best neighborhood. So this is something I've always done, but I'm trying to get the best product in the best neighborhood. I want my product to be nicer than the landlord down the streets, so I'm being really intentional about how I do my remodels, how I do my finishes, how I do my turnovers. And I think if you spend a little bit more money on the front end, it's going to reward you, especially if we do have some rental demand drop off that could happen. So those are just some things I think you should look out for. If you're buying new properties, make sure it's in an area with strong demand. I think those fringe neighborhoods that were probably worth taking a gamble on a year ago, 2 years ago, may not be worth the gamble going forward. You know what I mean? So yeah, any questions, comments on that piece of it?
Yeah, I have one.
Go
Where do
ahead.
I want to start? Well, actually two questions, but let's start with, so for like the tertiary markets, like, I don't know if you remember when I was first looking, I was like only Cincinnati, like downtown. I've started seeing some migration trends. It looks like Warren, Claremont, and even Butler County have seen, in the thousands of positive migration. What's your take on kind of those areas now? Do you think rental demand is going to stay strong and maybe even grow there?
Yeah, so I buy a lot in Claremont County. Like half my portfolio is in Claremont County. So I believe the suburbs of greater Cincinnati are definitely positively migrating in most of them. So like you said, Indiana, Northern Kentucky, Butler County, Warren County, Claremont County, they're seeing positive migration trends. And typically, like from the retail side, what you're seeing is that, and this is basically something you can look at for like the last 10 years. But when you have young people in college, they're going to be living in the college areas, right? Obviously, it makes sense.
Yeah.
When you have young people fresh out of college, they want to be in the more urban areas that have quick access to nightlife. So like some examples in Cincinnati for the people here, like Clifton, Norwood, Mount Lookout, those areas that are younger crowds. They have the bars, they have things to do. OTR, obviously another big draw here locally. So it's like they don't need a 3,000 square foot 4-bed 2-bath 3-bath house with a basement and a garage, because even if they're making really good money, I'm talking like young attorneys, young accountants, people with professional jobs fresh out of college, they like, generally speaking, to have that sort of young adult lifestyle, have access to that entertainment. Now, COVID obviously changed the dynamic a lot, because now even people in their mid to late 20s, even if they don't have kids and a wife and family or husband, whatever, they need more space. They're staying in their house a lot of times. So I've heard people call it like the great migration. Well, a lot of those people wanted to get out of the city, but there's a lot of people and no parking, and they're stuck in their house all day. And that created a massive trend towards the suburbs. So you always had the older millennials, let's say, and the recent generation, who are opting for the suburbs. They want more space. They might have a couple kids and a dog or whatever. Like they don't want to live in the city necessarily. Some of them do, and there's suburbs within the city limits. I'm not saying nobody wants to live in the city, but what I'm saying is that's why you're seeing this positive migration or population trends for the suburbs outside of the greater Cincinnati area, outside of the city limits, because people need space and they want a yard and all of that. And I think as more people work from home, which I think is a permanent staple of our, kind of modern economy post-COVID, I think that people are going to opt to have the suburbs, have a yard, have the parks, have more space. So I think those trends will continue. And that's at least what I'm seeing. you know, and I've obviously represented all of those demographics on sales. So talking to those people, having those conversations, I see what their motivations are when it comes to like the retail side.
Mhm.
Anybody else got anything to add? And do you have a second question? I think that was,
Yeah, I did.
Question.
Kind of on like your apartment complex stuff. You know, with the changing times now, like we've been talking a lot about like seemingly the next like 12 to 24 months, what that might look like. But how are you structuring your debt, or at least like your pro forma debt for your apartments? Are you shying away from even like 5-year balloons, or are you still open to 5, or sticking to maybe long-term 10 year?
yeah, so I can say personally that, and this is actually something I meant to mention earlier, I would not be on the investment side, I would not be locking anything up for less than 3 years right now.
Yeah.
Like I mentioned, the data I'm looking at, the people I'm talking to who know a lot more about the economic stuff than I do, they have zero faith in a lower, you know, the reducing rate market in the next 24 months.
Yeah.
So meaning that 36 months is still potentially risky. So the last like couple arms I did were 5-year. And I
Okay.
think that's kind of my sweet spot. I think 5 years gives us enough runway where even if we have a downturn, even if we have a rising rate market for the next couple of years, that gives us enough time to hopefully peak and, you know, kind of come back down to hopefully get some better long-term debt. So even my new personal residence that I'm buying, I'm basically done a live and flip the last couple of years. I'm going to be selling it, doing another live and flip. And I'm going to do a 5-1 arm on that just because it's a, you know, I'm getting like 2 points better rate, but it's a 5-1 arm. So
Yeah.
I'm taking the gamble that, you know, rates are going to be down, not up in 5 years. All right, anything else? Any other questions? And if not, we'll get to our personal questions here.
Just wondering if anybody had any thoughts, if you're looking at new deals, how we expect like, you know, rehab costs and stuff to shift. Material prices are probably going to stay the same, maybe go up. What about, you know, labor rates and things? I know you probably have a pretty good pulse on that, Joe. I don't know if there's any thoughts on that.
Yeah, I mean, if anyone has any, if anyone's seen anything, feel free, and I'm happy to chime in as well. So yeah, I mean, so for me and my business, because we're scaling, right? So we're hiring. The labor market right now is extremely difficult. And the last couple of hires I've had to make for my construction company just to simply get the manpower we need to operate the scale that we're at now, I've had to bring people in at really high rates based on their experience. So like all of my guys are in the 20s or higher per hour. And a couple years ago, that would have been like unthinkable. You know what I mean? So I have guys who literally have zero construction experience, but they have a good work ethic and they come to work and they're making 20 plus an hour. So, I mean, unfortunately, I think that that's the reality of the world we live in. It took me a long time to adjust and accept that, but that's the reality of where we are. And that also means that ultimately my customers are paying a lot higher price, right? And I don't think it's specific to this market or my company. I think a lot of people across the country are seeing these massive labor shortages, which is causing wages to continue rising, which is, you know, ultimately impacting the customers because they're obviously at the end of the day paying that price. So I don't see it getting better anytime soon. If we do have a massive recession, let's say we even have half of what we had back in 08, 09, you know, I think we could then see a rapidly increasing labor market and people who left the trades to go into like, you know, other better jobs with better benefits and less physical labor and all that stuff coming back because there's such a high demand in that field, which is also why prices have gone up so high. I think that's really the only way out of this. Two things. A national push to put people back in trades, right, that we haven't had since the 70s, or we have a you know, tech takes a 20% loss or 15% loss in staff. You know what I mean? Just across the board. And then what are those 20 million people going to do? They're going to go find other jobs. Well, a portion of those people are going to have to go into trades. You know what I mean? So those are the only two ways I see, it kind of easing the pressure on our labor market, at least as far as the trade market goes. So unfortunately for you guys, as most of you are customers, unfortunately, no, not any good news. And I don't think the construction companies, even though, they're making more money, it's also not easy on the management side of that as well. All right, let's, I'm going to post the questions here. I know there's a couple of you, I think it's your first one, so we'll start with you guys. So, hey, Kevin, are you here? You got your mic?
Yep.
Awesome. Is this your first call, or are you
It
returning?
is. Yep.
Awesome. All right. Well, why don't you start us off then? If you look at the chat, you should see the questions I just posted. Or did I not post them yet? No, I did post. Okay. Let me know if you can see that. It should be at the bottom where you click on the little chat bubble.
Yep, I can see it.
Cool. All right, go ahead.
Let's see here. My name's Kevin Jones. I'm located in Columbus, Ohio, and currently looking in the Columbus and Cleveland, Ohio market where I was born and raised. Currently we have a house hack in a duplex, and pretty much been stuck in like analysis paralysis for the past year, trying to pivot out of single family into multifamily. So I wouldn't even say analysis paralysis, but more so just like learning the business and ins and outs, and trying to pick up education in that. So pivoting away from focusing on single family homes. So I've kind of been stuck more or less doing that. So that's currently where I'm at. Short-term investment goals, 1 to 6 months, will obviously be to close my first multifamily acquisition, and long-term goals will be in 1 to 5 years. It'll be $100 million asset under management. So a big goal, but generally I like to set a big goal so that if you fall short, it's still, big.
Awesome. Yeah. And so you're in Columbus. What are you seeing in your market as far as the way things are going on the sell side?
It seems like everyone else is just like sitting out on the sideline and really don't know what to do. This place, as you guys, I mean, you're in Cincinnati, it's not far, you hear whatever, family and friends. It was scorching hot here, ridiculously hot for everyone, non-investors. You couldn't get a house, just my buddies at work that don't invest at all, just trying to get a house. You were bidding with 40 people. So that's kind of calmed down, but even with the interest rate hikes, these home prices are still pretty expensive. And then on the investor side, talking to wholesalers, talking to the hard money lenders in this market, it seems like everyone's just like sitting this out right now and trying to wait and see what's going on. Some people, but you have a few that are still pretty aggressive and taking things down. So kind of a weird time right now.
So what's stopping you from buying right now?
Honestly, for me, it's just like I said, I was 100% sold on just single family fix and flips, and I wasn't thinking as big as I could. It was just, hey, I'll try and get 30 single family doors at a $250 cash flow, whatever, and that's enough passive income. So at some point I switched, and I more so want to focus on larger multifamily. And the biggest thing is I've attained most of the knowledge I need to. I'm pretty sure it's just growing that network continually. And then the biggest thing, honestly, because I've had brokers send me decent deals, it would be networking and attaining private capital. So just, forging relationships and getting investors, honestly, at this point.
What's your W-2 job?
Firefighter.
Oh, nice. Thank you.
Yep.
Awesome. All right. Well, I appreciate you joining us, man. Hopefully you can keep coming back.
Absolutely.
All right, let's see, Liam, I know this is your first call, if you want to jump in here.
Yeah, sure, cool. I'm Liam DeLumpa. I'm located in San Francisco. I'm investing in Cincinnati. I actually met Joe on Bigger Pockets, and he was my agent for this first deal. So I started my real estate journey in January. And so I just got a first triplex, and I am looking to immediately get into larger multifamilies. I want to go bigger. So my, I do my goaling at a 90-day level. So my 90-day goal for Q4 is to be fully ready to start investing in multifamily. That means doing all the education I need, building relationships with brokers, lenders, property managers, have the whole thing ready to go. So all I need to do is start looking for deals and executing. So my 6-month goal would then be hopefully by Q2 to get an 8 to 20 unit. And then my long-term goal is just to grow exponentially. So this goal for year 1 was to get just $300,000 in assets. I'm hopefully going to do that if I rehab this on time. And then, so yeah, next year I want to get 600,000, year after that, 1.5 or so. And so my 5-year goal is to get to 10 million assets under management. And from this group, I'm definitely trying to just network, learn more about the market, give back in ways I can to other people. I love talking real estate, and I'm in my third mastermind now. With Jake, I'm in the multifamily boot camp for Bigger Pockets. I joined Terrence Doyle's, he's a Bigger Pockets kind of adjacent guy, his mastermind. Just trying to put myself out there and learn from other people who are doing it, and kind of just work with people. So yeah, that's kind of where I'm at.
Awesome, man. Yeah, thank you for joining us. And it's a part of what we do for anyone who's here for the first time. So one of the goals of this group is to talk about our goals. And the reason why, even though I know a lot doesn't change in 2 weeks, typically, I'm trying to force you to be accountable to yourself and to the rest of the group. So that's why if you look at the returning group questions, it's very similar. We're going to run through anything that has changed since last call or the last time you were here, and hopefully keep it in the top of your mind, and hopefully help us all stay accountable to each other. I think just forcing ourselves to talk about this makes it where you can't just sweep it under the rug. I know I'm really bad about that with almost every other goal in my life. Real estate, fortunately, has been something I've been able to focus and stay passionate about. But like working out, how easy is it, to say I'm going to work out, I have these fitness goals, and then it's like, you're sick for a week, you miss the gym, and then all of a sudden, you're back to square one. And so I don't want that to be a real estate story. So that's hopefully what I can help with everybody stay accountable. All right, Craig, I think it's your first time as well, right?
Yeah, it is. It is my first time. Hello, everybody. My name is Craig Hyson. I'm located here in Cincinnati. Currently, what's next question? Currently own 9 apartment units, 5-unit and a 4-unit. Actually, one of them is not too far from where Joe has one too, here in Mount Washington on the east side of town. So if you're from Cincinnati, the Riverbend, Coney Island exit, it's kind of where I buy mine at. It's also where I live personally. My short-term investment goals. Right now, one of my goals is to quickly turn a unit that I'm getting back at the end of this month. Thankfully, that one's fully renovated, so hopefully they leave it in good shape. But I'm going to try to raise the rent a little bit on that one when I get that back. And then 6 months from now, I want to have my primary residence listed, like Joe had mentioned. I'm currently doing a live-in flip as well, and our 2 years will be up in January. So I'm going to try to find another one, even though from Joe's dialogue tonight, I'm a little bit concerned that now's not the best time to be doing that, to find another house. But we'll see.
Yes and no. Yes and no.
So I'll be talking to you, Joe, as I get closer to that. And then what do I hope to get from this group is just continuing to learn from you all, as well as networking. I've been investing since 2016. So I got started by doing a house hack on my 1 apartment building. refied that, bought the next one. So they've both been bird deals. I recently did a cash out refi on the 4 unit back in, I want to say May, April. So the rates were still okay. So that was on a 7-1 arm that I refied that on. So that one's good. But trying to find another one, that's been my challenge. I've sent out a good amount of mailers, not as many as I should have. That's going to be one of my personal goals, to send out more of those in my market. But I just haven't got any hits on the couple hundred I've sent out this year. So I don't send out thousands a month like some people do. It's a pretty tight list that I send them to and follow up on, but I just haven't got any hits lately.
Awesome, man. Anything we can help you with today?
Right now it'd be nice to find a deal in my neighborhood. I'd like to keep it kind of around here for now. I mean, I'd look other places if it makes sense, but this is where I'm at. This is where I want to invest and make an impact. So just trying to find another deal.
Yeah, no, it is tough to find deals, especially off market. Yeah, and I'm happy at the end here. I would one of the things I was going to mention or talk about tonight was the live and flip thing. Obviously right now it's kind of top of my mind because I'm basically selling one and going into another one here soon. But you know, I'll talk more about that here in a minute. All right. So now Jake, were you here last time or is this your first? You were, that's right. Okay. And I think Angela, Josh, and Jake have all been here. Angela, you want to start us off with the returning members? So that's the second section there.
Yeah, that'll work. Let me scroll down, right? So, hey guys. So, name is Angelo Solari. I'm new to real estate, so I do not have any properties yet. So my goal is to hopefully within the next few months or so, put the first investment property under contract, which I am planning on house hacking, and then I plan on renting my primary residence where I'm at right now. I'm in the Cincinnati area. And then as far as any current needs from this group, again, building relationships, accountability, of course. I want to learn as well. And I think these kind of meetings and masterminds really help with motivation, especially with everything that's going on. The market's being so dynamic, and trying to find a deal right now. I think that's been the biggest challenge that I've been facing. We're actively looking, being aggressively patient, right, Joe? Like you wrote about a couple of days ago. But since last meeting, again, actively looking. I wouldn't really say any wins yet, but again, keep learning, right? Keep learning every day. So that's where I'm at right now.
Awesome. Thanks for coming back. Jake?
Yeah, so I too do not have any rental properties or investment properties. I currently have a primary that I do want to get on rental by April. And I want to switch my new place to a primary, and I'm looking for a duplex, triplex, squad, some kind. I am handy, so nothing's too above me. I finished the entire basement that I'm sitting in now. So those are my goals. In the past month, I've actually gone and looked at 2 duplexes. One was literally falling off the cliff. I do not recommend going looking at 1221 Martin Ave. Do not do that. You might die in that building. Recommend not going. Otherwise, I had one down in Kentucky. It was going to make it a little bit more difficult to make it my primary, and wasn't necessarily laid out correctly, in my opinion. So those are in the previous meeting, I said I'm going to get out there and start interacting and looking, and so I started doing that. Started also looking again since then, but I'm going out of town for a fair bit. So that's really what I'm looking at, is still understanding the market, getting out there, looking at duplex, quadplex, the whole kit and caboodle, and making those my primary, and putting this one up on rental long-term buy and hold aspect. Currently just networking. So yeah.
Awesome. What do you think your biggest, what's the reason you haven't been able to pull the trigger on a deal? Let's put it that way. Like, what is it you're seeing or not seeing or fearing from, closing the deal?
One, I don't want my place to fall off the cliff. Two, the numbers need to really make sense on a very, very, very conservative aspect. And one of them did, which was falling off the cliff. And
Okay.
so when I went and looked at it, it was just a no-go instantly. I mean, bank won't even lend on this. So this is just us to giggle at it.
Right.
The other one, the numbers were okay, but the layout was horrible, and was really needed a bit more work, and was, again, it was going to make it more difficult for me to make it my primary. I would have to switch states, do the whole kit and caboodle on that aspect. So that's really been my trigger issue.
Okay.
I just haven't found the right property. Again, got capital, got everything ready. And it's just a matter of making sure the numbers work on a very conservative aspect, because, as we all know, it's very, very questionable in the future of what's going to happen. I mean, we've got November coming up. Hopefully something changes, something's good. And if that happens, hopefully it will, continue with that. Or are we in this for the longer run? So again, it's a matter of being super conservative. And I got to make sure the numbers make sense if I'm going to make this jump. Is really what it comes down to. I mean, Joe, I think you're the same way. You got to make sure the numbers make sense. So
yeah, for sure. No, I mean, it definitely makes sense.
I got my primary is 2.5 interest rate. So
That's why you don't want to sell.
yeah, I'm not getting rid of this place.
Yeah,
Oh.
makes sense. What's your W-2 job?
I manage a fleet of vehicles for a sales company, basically.
Gotcha. Okay. All right, Josh, you want to finish this up?
Yeah, sure. So our monthly goal is to, I'm gonna say it's to actually put an offer in on this 11 unit off market
Nice.
place up here in Lebanon that we've been looking at driving by and not actually put any action into for almost a year. I talked to the seller or talked to the owner about a year ago, and he said he'd definitely be interested in entertaining an offer. And I'm just sitting it there and surprised nobody has scooped it up. And so my goal is to put an offer in, and maybe it won't go anywhere, but gotta start getting the reps in, right? So I think most important next step would be to actually put some underwriting around it, have another conversation with the seller, get some information. That's definitely the next step. Needs from the group, I don't think I need anything at the moment. Hopefully we'll have some more conversations about structuring some debt or equity partnerships with how to, get some input from you guys who've done that before. But that's a few steps down the road. Any wins or lessons? Our biggest win, which really diverted our attention over the last 6 weeks, we had 3 of our tenants in our 9 units submit their 30-day notices. So we rehabbed those units. This was the first time they were vacant since we bought the property, which unfortunately fell to me to do the flip in the name of saving cash. But we got all of them flipped, all units filled with great tenants, and didn't have any vacancies. So it's a pretty big win.
Awesome.
Vacancies are number one thing to try and avoid. So that was a big win. Kind of consumed our life for about 6 weeks. But
That's awesome, man. Congrats.
yeah, thanks. So lessons, I guess, would be try and have enough cash where you're not trying to rehab 3 apartments yourself over a month.
Yeah, no, for sure. I've been there. You know, my early days, I was doing most of the heavy lifting, and it's not fun when, especially when you're working, you know, other jobs and family and all that
Yeah,
stuff.
get home at 6, go to bed at 2, but
Yeah.
hey, part of it, right?
Yeah. Yeah. Hey, you got to do what you got to do until, you know, till you get to the top of the
Yeah.
hill there.
Yep.
Awesome, man. Thanks for joining us. So yeah, just real quick, I'll run through mine and then a couple of things that I was going to mention. So, my monthly goals were to complete one of the new property turns. Our first renovated unit in Clifton will be coming online. Hopefully by the end of the month. We were waiting on cabinets. I think we're supposed to get them next week, and hopefully we'll wrap that one up. I think we have 2 more in progress down there. So that's going well. Ran into some hiccups, you know, throughout the process, like always, but we're working through them. So nothing too out of the ordinary. I am somewhat looking for new properties, but as I mentioned, I am buying a new personal residence. So that's going to tie up cash and time. So that'll probably take some of the, momentum out of my property search as to adding to my portfolio. So yeah, I mean, my most important next steps on my current goals are just, you know, the way my kind of day to day with the construction business and the way I'm managing the turns on the properties is basically just trying to stay actively involved in overseeing the supervisors on site, making sure they're doing what they're supposed to be doing and their employees are doing what they're supposed to be doing. And my role has definitely transitioned as I scaled up into more just a visionary slash, you know, kind of project management role. So at this point, I'm basically doing almost none of the work on any of the properties or projects we're on, but I am managing a lot of, you know, moving parts. So it's different challenges, kind of a different role that this past year I've had to grow into. But mainly all I do is put out fires all day long. You know, people call me with problems and I have to solve them. It's pretty much what I do for most of my waking hours. And obviously I'm still selling real estate, and we are doing some third party contract work for a couple of clients as well. As I've scaled up my team, we've obviously been able to take on more work and more projects. So you know, it's been going well. No current needs from the group. So I'll finish up with the lessons, and this is something that's back to something top of mind with the live and flips. So I did my first live and flip in 2011, and I'm going to probably make a more, you know, in-depth video about this, and I'll share it with the group whenever I get around to making it. But I was kind of doing some loose math in my head. Did my first live and flip in 2011, sold it, obviously took a tax-free gain from that, bought a personal residence, got divorced and had to sell that. And even with losing half of the equity from that property, I took that property, I bought a house hack, and then I also bought another primary residence later, kind of with that same money, if that makes sense. And now I've been in my current house for like 2.5 years. And this was definitely my most involved live and flip. But if things go well, I'll be able to net somewhere between like 150 to 175 in net or in tax-free gains, which I'm then going to be putting a lot of that into my next live-in personal residence. So the point of all this is, in 10 years, with only doing, let's say, 4 live-in flips, this will be my 4th, and almost somewhat unintentionally, I'm basically, after this live-in flip's done, and you know, we don't know where values are, as we mentioned, but on a conservative estimate, when this live-in flip's done, I should be able to generate somewhere between like 300,000 to 400,000 in equity. And the reason why that's so powerful is because all of that was tax-free, and there's no other vehicle in real estate that you can do that with, right? Obviously, you can defer taxes, you can reduce your taxes, but you can't have tax-free money outside of using your personal residence. So like I said, it's something I wanted to mention because I want to reiterate, my first one was 2011. I didn't know anything about real estate. I literally bought a crappy house. I fixed it up myself with a little bit of money, and I made a profit. Now, again, I will say as a caveat, obviously, we all know the last 12 years have been a great time to buy and sell real estate up until now. So I've had a lot of market appreciation. So I'm not saying I'm some genius by any means, but what I'm saying is that throughout your lifetime, you should be able to continuously cycle that tax-free money. And as you scale up and you start having kids or more kids and families, and you're going to need more space. I mean, that's obviously my primary reason I'm moving is our house is full. We have 2 kids. We want another one. So we just don't have any more space, but I'm still looking at ways to be strategic, even with fitting in what I need for my family and what we want, So again, I just want to something to think about if you're not already doing it, if it's not something you've already considered. House hacking is awesome, but house hacking with capital or with tax-free money is even better. So if you guys have any questions about that, I'm happy to hang out for a few more minutes and talk about it. But yeah, again, something I wanted to mention before we got off here. Cool. If anybody's got anything, you feel free to reach out. If not, we will have our next call on the 2nd of November. So I will see you guys then, and we'll probably have another interview set up for that one. So I'll put out the info on it when I have it. Anyone got anything else?
Sounds good to me. I'll try to make it on the 2nd. I'm starting to travel around then, so.
Cool. And like I said, so we recorded this one, and let me go ahead and stop that actually.